I started out Monday's video with this tale of two markets situation that reversed itself yesterday, but then is right back at it today. So again, another tale of two markets where this weakness in this large cap tech space, but strength in everything else, right? So we're gonna break that down again, continuing to see whether or not we're getting enough strength to carry us to outweigh the weakness in the tech index, and which one's going to win. That's a tug of war right now between risk appetite on one hand and risk aversion on the other. Which one's going to win that tug of war? So we're going to break that down in today's video, so check that out as well. Our trade idea of the day is a stock that has been like going gangbusters all year long. It's been on pretty much an 11-month intermediate rally. I'll show you that today. So now, how do we trade a stock like that? It's in one of these sectors that has been doing very well, but we don't know how long they're going to continue to do very well. And with this stock that's been so strong, how can we trade that going forward from here? So let's go ahead and get started. Today is Wednesday, March the 10th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500. I have to admit, spent most of the day, in fact, we just barely got back just not a few minutes ago, but a little bit ago from Bryce Canyon, the first time I live in Utah. We have the 5 different national parks here, and it's the first time I've actually been to Bryce in the winter to see snow, and I've always heard it looks really nice with snow. A little bit more difficult to hike with the snow on the ground, but making it a little bit more slick, especially on the steeper hills, but fun nonetheless, and highly recommend. So if any of you are thinking about making the trip out, definitely should put it on the list. All right, let's take a look at how the S&P is doing here. As you can see, the rally today back to dark green shading the green line. So 2 days now of dark green shading the green line again. The intermediate line turned up without getting below the reversal zone. So we never did get dark pink shading with that few days of red line that we had when we were below the moving average. You see now how we get back above the moving average and the gains get smaller, right? They're not as big as they were when we were below the moving average. The nature of the beast, right? The near-term line, is rallying up here, back up into the reversal zone. It's gotten up here a couple of times before, kind of to this level, without necessarily getting strongly bullish. So we need to kind of keep an eye on the near-term line to see if it follows through with that tomorrow to a higher level, or if it rolls back down. If you take a look at some of these others, like the Dow Jones, which has maintained its bullishness, it had a really good day today, up 1.5%, closing at new all-time highs. Very, very bold. The intermediate line's back above its market sentiment line. So about as bullish as you could actually be. They're very bullish, but that's not the case in the NASDAQ 100. You can see we are back to light green shading because the intermediate line is turned up above 20, and the near-term line still rallying. But that's a pretty bearish close to gap up that much and then come down. We didn't quite come down to the point where you consider that a piercing line, but and we are not back below that 38% retracement level of this rally that we've had. One of the lines I showed you today in a tweet off my iPad while I was eating breakfast, I noticed that that we had come back down. So when you look at the retracement back up here, we had gotten back to a 38% Fibonacci retracement. We had opened up above that 38% retracement level and then finished back down below it. So again, you can see we are just not, light green shading, but well below the moving average. So not turning bullish anytime soon on the NASDAQ 100. The Russell 2000, like the S&P, back to dark pink green shading and the green line. So one of these things is going to give. Either, as I've said before, either the rest of these indexes are going to follow suit with this intermediate pullback that we are getting on the NASDAQ, and it just hasn't been because we've been sitting between 0 and 23 on the SPX. So we've actually got new all-time high again today on the Dow Jones Industrial Average, and then you can see we still don't have a new high yet on the Russell, but we're getting closer to to new highs here, even if we're not quite getting them, not even close to getting one on the NASDAQ. So which one's gonna give, right? Are we gonna follow suit on those others With the Nasdaq unable to get, say, back above that 23% level and stay there. See, it's gotten above it a couple of times, but hasn't been able to stay above it. Especially, both times being below the moving average. Next time you get above it, it might not be below the moving average, so it might have a better chance at staying. You can see the moving average in a few days will be below that 23%. So if you are to get above it, the next time you might be above the moving average. You might have a better chance of it holding suit. But see, none of the other indexes have broken their 23%. Not the Dow, not the S&P 500. The S&P came the closest. It actually did briefly, much lower on the lowest scale, but bouncing back up both times. And then the Russell, not even close. It briefly got down there a few days ago, but didn't come close to closing down there. Obviously, we closed much, much higher. So that's the case right now. That's going on the S&P 500. Very, very strong bullish move again that we're seeing across the board on pretty much every other index except for the NASDAQ 100. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback. If you don't like our videos, you don't have to click on anything, of course. You don't even have to watch if you don't like them. But if you do and you want to let us know, you can do it with one click. You can do it right now even while you're watching. That goes a long way for us. Also, while you're down there, comment. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Join our website at marketscholars.com. There's a link popping out there in the top right corner of your screen. Click on that link to subscribe to our site for free. You get access to our Market Outlook forum in our community for free. So click on that link to be able to get access to that. Follow me on Twitter for more content in between the videos from day to day. There's my handle right here at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out our Market Outlook live videos. When I do the Market Outlook, except for today since I was out of town, but most every other day I do the Market Outlooks. I also do a live video at 3:30 Eastern Time. I review all the trades we've been doing. I stay in them, right? When I give you a trade idea, I don't just say a name, right? We actually do a trade. We position size it according to our class portfolio risk management. We stay in the trade until we close out, and I continue to manage that trade here in this video. So if you want to see that, check that out. Again, that's available for all of our paid subscribers, our premium and our monthly subscribers. Here's all of our trading rooms as well. You can see we've got a couple of my trading rooms here to finish up the week. Brandon's Q&A session tomorrow. All of our paid subscribers also get access to all of our trading rooms. Our premium subscribers get access to all of that and the Q&A sessions, as well as all the communities, all the class forums for each of the individual classes, as well as other premium tools. I noticed there's been on Twitter, a lot of people have been pointing out some of the new tools, especially that Brandon has put out there lately, including the stock selector and the factor selector. So check those out. There for our premium subscribers. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also hit this thumbs up icon. Opens up another new tab. Hit this icon here as well. This thumbs up. Again, the more you do that, the more our content gets seen by more of our followers because it has more engagements. That's how Twitter and Facebook works with their algorithms. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, let's get back to the charts here. And let's take a look at the long term, the weekly chart and how it's unfolding here. And you can see we're still kind of a neutral candle, upper shadow, lower shadow, very small body, very neutral, right? No bullishness yet. Of course, that's not the case with the Dow Jones Industrial Average. It has a very bullish candle, about as bullish as you could be on a Hakinyashi basis, closing up here. We kind of had a couple of transitions, regained some bullish, a couple more transitions, regained a bullish. That's not the case with the S&P, obviously. The Russell 2000 is trying to figure that out, right? It's trying to do something similar that it did right here. But of course, the NASDAQ is the big one. As you can see, it continues to show falling momentum and bearish candles, filling in this gap between the 50 and the 200-day moving averages. That's the issue. That's the concern. And we're not popping up back above that 12,904 level, which is where that 50 or 10-week exponential moving averages, or 50-day. So that would be, right now we're at 12,752. So it shows how far away, about 150 points away from getting back above that level. Let's take a look at the 3 green arrow chart. Obviously, we're back to 3 green arrows. The volume is tapered off, but still above the average on the volume. You can, from a 2-line version, see that the MACD is not only crossed above its moving average, which is what gets its the histogram green arrow, but it's almost close to crossing above 0. The stochastics has crossed above 50 again. It's back to close to crossing above 60, with the 8-day and the 17-day close to crossing back above the 30-day moving average. You can see how bullish the diamonds are. Look how far above the 30-day moving average they are. That's the highest level on this current intermediate run. So, when you look at it in that case, we are the most bullish now. Here, let's go down here and let's go 1 to 30. Do simple. How far this? So this will show how far above the 30-day moving average we are, and you can see since the beginning of this intermediate rally, we're up here at about 5%. We got the 6.11. We got the 5.39. Today we are at 3.37. As if I put my cursor right there, you can see going back, that's the last time we were that far above the 30-day moving average. So, all these other subsequent runs have not been as bullish as we are now. So it looks like it's trying to make another run towards that 5% mark. Again, that's the diamonds, and then there's your IWM. Again, see how bullish it is. It is back above 0 on the MACD with the histogram green arrow and the 8 and 17-day rising. Not the case on the Qs. So again, the Qs and moving average, the MACD is well below 0 and still below its moving average. Stochastics is above 20, so we do have the green arrow there. Obviously, no green arrow no green arrow here on the moving average. And you can see how, here, let me get rid of this drawing here. You can see how we started the day above the 17-day. It's similar to that one. Where we started, we got above the 8-day, had a little bit of a rally, got back above the 8-day, started the next day above the 17, but finished below the 8, started the next day above the 17, and pretty much, just barely got below the 8. The 8 days at 311.01, we closed today at 310.88. So very similar. That time we pulled away. So we'll see if we end up doing something similar to that again. And you can see there, the MACD was turning up at the time. It's turning up again. That time we didn't cross above 20, the moving average like we did this go around. You take a look at the DMI for SPY, and we are, like, the ADX is below 20. The lines, the negative line is getting back. It's still above 25. So it's basically saying we're not done with this bearish move yet, even though we've popped. The negative index is still above 25. The positive index is still below 20. The Qs have the same pattern, just different, just higher above 25 and lower below 20. But the SPY, that should give us a little cause for concern there. The diamonds, that's obviously not the case. But you notice that we're not as positive as it seems, because we're not above 25 on the positive index. We're not below 20 on the negative. The ADX is about as low as you could possibly be, suggesting that there's just no move right now. And then again, the small cap index, the positive has jumped above 20, but the negative hasn't dropped back below that 25 level. So after having such a strong bullish run, it's saying don't count on a new strong bullish run here. And you can see very similar indicators here. We're in the neutral zone on the S&P. Again, look at the Dow Jones Index, and you can see not in the neutral zone. They're both in bullish territory, but the Russell is close to being in the above in the positive, and the Nasdaq is still is just barely in the lower end of the neutral zone. So again, kind of showing the discrepancy in the markets here between those two. The Bollinger Bands for SPY, we are back. We are flirting with getting into that upper quartile of the bandwidth. The diamonds is really far up above. That's not necessarily the most bullish sign, because you can see when you get really far up above it, it tends to not go anywhere after that. So that's something to keep an eye. That's a very strong breaking above the value area too. We'll see if that ends up holding or whether or not it ends up being a fake out. So we'll see as soon as tomorrow on that. You can see the The IWM still well up above and is in the upper quartile for its bandwidth, was the Qs are just barely out of the lower quartile. So we had flirted with that moving average again, and that volume node, which is here in that area acting as resistance, but has been unable to get through it. And we'll see if we end up, again, forming the same pattern that I showed you before going into next week. All right, now let's take a look at how the intraday chart showed. And you can see, again, we had this gap here this morning as well. Second day in a row with a positive. In fact, actually close to what, the third, fourth day in a row that we've had in the gap to the upside. The other two filled pretty quickly, right? These two filled pretty quickly. This one hasn't filled at all yet, right? Not even like just a smidgen from the open. And then today is mostly filled in, and you can see how we're hovering around this really strong point of control of the volume area. Still no new high, so the high tag is still far on the left. We'd have to really, we'd have to break through this 391 area if that's going to happen, and we were kind of unable to do that here. We got up to, about 391 and a half, but we weren't able to hold that breakout, and we came right back down at the end of the day. And you'll see how that performed. But you can see why it's kind of stalling here. And that high is going to be there unless we get a new one. That high is going to be there for 1, 2, 3, 4 more days, or 3 more days after today. And then the next new high is going to come down, into this area, into this area, and into this area. So it's still going to be here unless we get, and that's still above. We still haven't crossed above that level. You can see forward to the right that follow the horizontal line. We still haven't produced the high above that. So the high is still going to be here on the left of this low tag until we can get up above, say, 392, right? And then we'll, at the very least in a few days, get a new high tag up here on the right, which is significant to changing this bearish trend. That's not the case with the Qs because the Qs are not even close to getting a new high tag. The high tag's there for 3 more days. It will be here, it'll be here, it'll be here, and we're not anywhere close. I mean, coming down to here, and then over to here to this level, last week's high point, and we're not even close to getting above that high. And then again, like I said, we'll see how we play out with its point of control, the NASDAQ, which is right where we're at too. Just not, it's not the same one as we see on the S&P because it's a lot further down. IWM, you can see is a lot closer. I mean, the new high after today will still be there tomorrow, but then after that it'll be right here in this area, and we're flirting with that, right? We're flirting with getting a new high there. So all these indexes, of course, the Dow is forming its new high way over here to the right. So it's a rune indicator. You can see I've been showing you this rune indicator here. It is obviously much higher. The green line, the red line didn't stay above the green for very long. The green's back up there. The green's not quite there yet. As I said, it's still far over here to the left, and we'll stay over here on the left unless we get a new high here in the next couple of days. The low tag is moving, so and we're not anywhere close to getting a new low tag either because the low tag is so far down there. Again, not the case for the Qs. The Qs, the low tag's much higher. We're a lot closer to it. The high tag is just going to make its way down here towards 0 because we're nowhere near touching that one. So keep an eye on, again, that's bearish pullback mode chart that we're just not seeing yet here, but we are seeing the makings of it here on the S&P, even if we haven't necessarily broken that 23% Fibonacci retracement level yet. Let's take a look at today's volume. I told you it was below what it's been dropping, still over 100 million. The trading range got really small. So let's see here. Let's see what the trading range was. It was 3.25 points. You have to account for the average, the gap. So 387.17, the low at 388.17. So you add another dollar. So you're at 4.25 points with 110 million shares trading. So 4.25 points is below the average, way down here. So that's well below that average here. Now that we're back above the moving average. The 30-day moving average. 109 million though is not below, so it's just barely above the average. So we'll see. Remember the ATR is high. That's still above 1%. 4.25 points is still above 1%. 1% is just under 4 points, 3.89. So it's still above what it's lower than average, but it's not still below that 1% where you need to be to start bringing this average back down. And remember, you're really kind of grindingly bullish. See this, a lot of this bullishness again, you know, we consider how bullish we've been, but keep in mind a lot of this bullishness is because of how bearish that was. You know, it provided a really significant springboard. But you can see with the ATR as high as it is and volatility as high as it is, this is all still a function with how big and how deep and how fast that drop was. It just gave us a big time springboard. It's like a trampoline here. We just, you know, we get way down the trampoline and it brought us back up and then some up in the air. Really, really significant pop-up on the upside in the trampoline. And what this is saying is this bullishness is still a function of that. We still haven't established, you know, our own kind of trend where the ATR is below 1%, and we're not to that point, and when the VIX is below 20, and we're obviously not to that point either. We're down, but we're kind of stuck here at this 85% mark and stuck here in the low 20s after making a couple pops here in the last couple of weeks up to 30, up to this 30 area. And the last couple of pops got us up to the top of this neutral zone, coming from the last time coming from lower levels than we're at right now. So we'll see where the next pop will eventually end up taking us here. So to summarize my technical outlook here before we look at what's driving this action today, you know, obviously we're still pretty bullish in the S&P and especially the Dow Jones, which remember is only a 30 stock average, a price weighted average. So not even a market cap weighted average, but a price weighted average of just 30 companies that are hand selected by the Dow Jones Dow Jones companies. So keep that in mind versus say the more passively indexed like the S&P, which has all those stocks in it too, but then the Russell 2000, which are all pretty bullish, kind of trying to renew this continued very mature bullish run that they've been on. The NASDAQ, however, appears to be the harbinger of what's to come. Because as much as these others have really gotten bullish, the NASDAQ hasn't. And the NASDAQ, as you'll see here in a minute, just continues to really underperform going forward. So considering that a lot of these index are market cap weighted, and a lot of those NASDAQ 100 names are so big in their market cap weightings, it's hard for the markets to really sustain, you know, to engage a new intermediate run, much less sustain a very mature one that they're already on, that they haven't ended yet, that they've only ended so far in the NASDAQ 100. So I expect sooner rather than later that the rest of them will follow that pattern. It can go either way. The NASDAQ can follow the pattern of these other indexes and re-engage a new run. Not the others because they never pulled back, but the NASDAQ did, so it would be a new run for the NASDAQ. But if it did, it would be very short-lived, as I think. I expect more will be the former, where the other indexes will follow suit eventually with what the NASDAQ has been telling us here all along and giving us plenty of forewarning for. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why you're a lot more either bullish than I am or a lot more bearish than I am? All right, now let's take a look at what's driving the price action. You can see small caps continue to be a big winner this week, up 4%. In fact, if you look at the index here, the chart for the relative strength of the NASDAQ relative to small caps, we can see that we actually closed lower than we did on Monday. So very significant drop in the relative, after it bounced back yesterday, a very significant drop in the relative strength for the small cap index. Obviously pretty bearish on the CCI still, pretty bearish on the still below 40 on the relative strength index, the RSI. And then, of course, the MACD continuing to fall with a falling histogram. So pretty significant underperformance. And remember, again, in my opinion, once this rallies, it will actually rally with a move in risk aversion for the broader markets as a whole. So as of right now, we're not seeing that yet, and you can see that here. Though equities still are outpacing every other asset class. Look at bonds. Bonds are rallying a little bit, but not very much. The dollar's down, commodities are down, emerging markets are down. So, and those had been very bullish. So it's interesting to see we're seeing weakness in other charts, not just the NASDAQ 100, right? So if you look at the market forecast for like commodity prices, you can see, you know, they're not falling off a cliff, but you can see that they're kind of like, we got this cluster here and they're kind of stalling in a sideways pattern as that moving average is quickly catching up to them. So that's, again, not bearish, but, again, kind of losing its bullish momentum. Same thing with bonds. They're not bullish. We're not taking off to the upside, but we're not dropping anymore either. We started to fill in that range from a week or so ago. We're still down there, and you can see the near-term line popping up to a pretty strong level, higher than what we've seen in a while, higher than what, so all the way over here when we had, before we had really gone bearish with all these oversold clusters. So it's a very good sign for bonds, considering how bearish they've been. And if you look at, the long-term crossover chart here, again, look how bearish. I mean, look how far down below the 200-day moving average. Just for some context on that, let's put this as a 1. So it's far below that exponential moving average. Obviously, it's one of the lowest levels we've seen. It was lower. Just barely lower over here during 2016, the very end of 2016. Let me go out 20 years on TLT, and you can see again, I mean, like, this is about as low as you get below the 200-day moving average for long-term bonds. There's that period there of significantly low long-term bond levels, and again, they didn't start a new bullish trend, and I don't think we'd start a new bullish trend either, but you notice they stopped going down at that point. And same thing over here, we hit this level. This one actually did start a bullish trend, and I don't believe that's the case, but again, we kind of stopped going down over here. Same thing here at these levels. You can see all these red dots where we have these, where we are in that very low, below 10. I believe it's below the 10. Let me just make sure on that. Here. And 1 second. Yes, it's below that 10th percentile down there at the bottom. So all those other times led to a bullish move in bonds. Some of them to a pretty significant, to a golden crossover environment. I don't think we'll get to a very lengthy golden cross environment. I think if anything, it'll be like this, like it was in 2017 before we roll back down and get back down to eventually down to these levels by the time all is said and done. But obviously a very significantly low PPO, or basically how far below the 200-day moving average we are. It's hard to sustain that depth for that long, as you can see on a lot of these other charts. So keep that in mind. We're not rolling back up. We're not close to a bullish pattern here anytime soon of dark green shading the green line. But I wouldn't expect a whole lot of bearishness to come out of this either. One last look at the dollar, which also has been a function of what's going on here, and you can see, it's bounced back up the last couple of days off of this cluster. Same thing we saw over here. The difference is this cluster, we had been below the 38. We made a run back up to the 23. We're a lot lower, so it's not going to make a run back up to the 23. If anything, we make a run back up to this 23 of the longer term line. We hit that for resistance there at the bottom of that low. And then we roll, but if that, right, if we don't roll over right now, but I see that's kind of where our resistance will be before we roll back down with a new near-term move back to the downside. And again, eventually make it down to the 1750 levels, 1760 area that we've talked about before as a target before this bullish dollar rally is over with. And it won't be over until we get more of a broader risk aversion trade that, again, we're still only seeing in the NASDAQ 100. Hasn't gone to other, and for that matter, in XLK and XLC as well, or XLY too, but still not. It's not been broad enough yet to be considered really a broad risk-off trade. All right, so when we take a look at how the sectors are doing this week, remember this small cap index was doing so bullish, commodities were doing so bearish. Well, you can see XLY has been doing great this week, but the rest of them are typical. In fact, materials is up there, financials, industrials, but it's interesting to see utilities and real estate doing so well this week. So, I mean, again, that's very typical in staples too. That's very typical of a risk-off move, not a risk-on move. And you can see technology and discretionary down here at the bottom, along with energy, which is not surprising. You look at the 12 grid here. Remember, utilities and real estate have been so bearish, they're finally turning up. And look at those highs in materials and energy and financials and industrials, very, very high off their 30-day moving averages, whereas technology is still below its 30. Discretionary, as bullish as they've been, still below its 30 and this week. and then XLC, which has been struggling to extend away after that overbought cluster, whereas all these safe haven trades are starting to look a lot more bullish. So it seems to be that, you know, we've got this rotation going on still. Here, let's go to the sectors, and let's go to a daily chart. All right, so here's our energy, industrials, materials, financials. You can see they're still got relative strength, but they're losing their momentum. They haven't fallen below 100 yet, but you look on the other side, utilities is rising, healthcare, staples is rising, technology and discretionary still are kind of rising. Same with the communication services, but again, they don't have the same momentum as these risk-off sectors do. And they would be the, you know, they wouldn't have, these look like they'll get past 100 on relative strength first before technology and discretionary will. So again, it kind of shows that we're getting into risk off mode away from these cyclical, small sector weighted areas, and letting these large sector weighting areas outperform them, even if we are still actually in a broader risk off rally, because they've already, as we've seen, they've already fallen so much that when they start to outperform their smaller sector weighted peers, this will go up. This chart will go up, but it will go up as we are in a broader risk off move, not a risk on move. Eventually, it will transition like it did in June. See, when it first bounced up here, it was a risk off move till the end of June, and then the rest of this rally was with a risk on rally until we peaked at the beginning of September. So something similar would happen here to a different degree, right? We would probably go up a little bit longer while we're in a risk-off mode before it transitions, while we're still bullish on this chart to a back to a risk-on mode, led by, you know, these sectors, the technology, discretionary, communication services sectors that are so dominant within the NASDAQ 100. All right, this leads us to our trade idea of the day, and I actually want to take a look at Freeport-McMoRan. We've traded this stock before in class. You can see how, like, we've been so very bullish on this. That we've been on the bullish intermediate run for a long time. Like, we never did get an intermediate pullback here, even though the intermediate line briefly got below 50. Obviously, never dropped below 40. This one barely dropped below 40, but just barely. Again, no red line on either one of these. So Freeport-McMoRan's pretty much been in the intermediate run since March, right? Since we got above here in the middle of April. I mean, we're going on 11 months now that this stock has been on a single intermediate run with the market sentiment line up, you know, this entire time. So that's led to a very strong PPO. If you look at the long-term chart here, I mean, 38%. Almost 40% gap between the 50 and the 200-day moving averages. You know, we don't have to like fall off a cliff here, but it's hard again to sustain such a strong trend when you're already starting to roll over in that level. You can take a look at like trend strength for FCX, and there's been a few times where it's ended during those two pullbacks, but again, not enough to even show, you know, to have any kind of bearishness, right? So there's to kind of give you an idea of what bearish moves. Bearish intermediate pullbacks moves look like. You can see here, and we didn't get that either one of those times, and so we're still in a strong bullish run. But you notice how the green line's dropping. We're barely above it. You look at the Bollinger bandwidth for FCX, and it's falling from pretty high levels back down. When it starts to go down towards its lower band here of this range. To lower bands of its range, you can see that it just goes sideways, especially when such a high bandwidth that it still actually has. From a directional movement index, you can see also that the ADX has been so bullish for so long, but now it's kind of going sideways too because it's about to drop below 20, which means its positive and negative indexes are just kind of stagnant right by each other. So as bullish as this has been, it's kind of setting up for a range where we just kind of stay stalled in the middle. And you can see it's right smack dab in the middle of its 4-week range, kind of like how I like to do the setups for when I'm doing a iron condor spread. So let's take a look at selling the 20 delta. So we'll sell the 40 by the 42. So we'll sell that 20 delta by the 42. Come over here, sell the 30 strike price, so 21 delta, buy 2 strikes away. That's where it gives us about 60 cents credit depending upon where we can get filled in tomorrow morning, since I didn't do a market outlook live today. Position sizing full because I don't have to have we won't have earnings till after April expiration, so we can position size full here. And then you saw the break evens and where they ended up being here on the Bollinger Bandwidth. You saw that the break even, those two blue lines are outside of both the bands, right? So we'd have to break out of the bands for us to get to a break even on either side. So really good setup here. So I'm going to go ahead and right click and confirm and send and put that into our market outlook category. Again, I review that trade in the Market Outlook Live. So whenever we look at that on Friday, next time we have a Market Outlook Live, we'll review that trade and all the others that we still have on from prior Market Outlook videos. All right, so that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Remember, all of our paid subscribers and our free subscribers get access to that forum, to that particular forum. So participate there. Let's keep this conversation going in between videos. As always, thank you very much for watching tonight. Remember to subscribe to our YouTube channel. Hit that thumbs up icon down there. Comment on our video. Remember to like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.